In 1998, some of the smartest people on Wall Street built what they thought was a money machine. It was run by legendary traders, backed by Nobel Prize-winning economists, trusted by the biggest banks in the world. And for a while, it looked unstoppable. But then, in just a few weeks, this genius hedge fund nearly collapsed the global financial system. Not because of fraud, not because of a bad stock pick, but because the smartest people in the room convinced themselves they had eliminated risk. This is the story of long-term capital management, the hedge fund that almost crashed the world. Long-term capital management, usually called LTCM, was founded in 1994. And from the outside, it looked like the most elite financial operation ever created. This was not some random group of gamblers placing wild bets. The fund had Wall Street legends, elite academics, and mathematical models that were supposed to find tiny mistakes in global markets. Their strategy was complicated, but the basic idea was simple. They looked for two similar assets that were priced slightly differently, and then they bet that those prices would eventually move back toward each other. Think of it like this. Imagine two nearly identical houses on the same street. One is selling for way more than the other. LTCM's strategy was basically saying, that price gap does not make sense. Eventually, it should close. So they would bet on that gap closing. In finance, this is called a convergence trade. And when it works, it feels almost magical. You are not betting on the entire market going up. You are not betting on one company becoming successful. You are betting that temporary price differences will eventually correct themselves. At first, the strategy worked extremely well. Investors loved it, banks loved it, Wall Street loved it. LTCM looked like proof that math could beat the market. But hidden inside that success was the thing that would destroy it. The problem was that the price gaps LTCM found were usually tiny. Tiny gap, tiny profit. So to make huge money, the fund needed huge positions. And to create huge positions, it borrowed. A lot. This is called leverage. Leverage is what happens when you use borrowed money to make a bigger bet than you could make with your own cash. Used carefully, leverage can increase returns. Used recklessly, leverage turns small mistakes into disasters. Imagine you have $1,000. If you lose 10%, you lose $100. That hurts, but you survive. Now imagine you borrow enough money to control $30,000. A 10% loss is now $3,000. You did not just lose money, you lost more than you started with. That was the danger LTCM created. Its trades were designed to make small, steady profits, but the size of the positions made the risk enormous. By the end of 1997, LTCM had around $129 billion in total assets, about $1.3 trillion in notional derivatives exposure, and leverage of roughly 28 to 1. That is the part people forget. LTCM was not dangerous just because it made bad trades. It was dangerous because it was connected to almost everyone. Major banks, brokerage firms, derivative markets, bond markets, international markets. It was like one giant knot in the middle of Wall Street. And nobody fully understood what would happen if that knot came undone. So why did the biggest banks in the world keep lending to them? Because LTCM had status, it had reputation, it had brain power, and for years it had results. This is one of the most dangerous combinations in finance. When someone makes money over and over again, people start assuming they must know exactly what they are doing. Banks wanted LTCM's business. Investors wanted access. Competitors wanted to copy them. And regulators did not fully see the risk building in the background. The phrase that matters here is systemic threat. That means the problem was not just that one hedge fund could lose money. The fear was that one hedge fund collapsing could trigger losses across the entire financial system. But before the collapse, LTCM did not look like a threat. It looked like the future, a fund run by geniuses, powered by mathematics, making money from inefficiencies that normal traders could not see. But there was one problem with their model. It assumed markets would eventually behave normally. And in 1998, markets stopped behaving normally. The late 1990s were full of financial stress. In 1997, the Asian financial crisis shook economies across the world. Then, in 1998, Russia's financial crisis exploded. Russia defaulted on its domestic debt. Investors panicked. Money rushed away from risky assets and into safer ones, especially U.S. Treasury bonds. In normal times, LTCM's trades expected price gaps to narrow. But during panic, price gaps did not narrow. They widened. And they kept widening. The trades that were supposed to correct themselves moved violently against the fund. The problem was not just that LTCM was losing money. The problem was that everyone else was trying to get out of similar trades at the same time. In a calm market, you can sell. In a panic, everyone wants to sell and almost no one wants to buy. That means prices move even more violently. And because LTCM was so leveraged, every move against them created massive damage. This is where the Genius Fund became trapped. Their models had studied history, but history had not prepared them for everyone panicking at once. LTCM's strategy depended on one big belief. Markets may be irrational for a little while, but eventually they return to normal. That sounds reasonable, and most of the time it is. But the dangerous part is that eventually can take longer than your money lasts. LTCM may have been right in theory. Some of those price gaps might eventually close. But if your losses get too big before that happens, you are finished. This is the difference between being right and surviving. You can be right about the long term and still get wiped out in the short term. That was LTCM's nightmare. The fund had built trades that looked safe on paper, but when markets panicked, those trades all started moving the wrong way at the same time. Diversification was supposed to protect them. Instead, everything became connected. The safe trades were not safe. The hedges did not fully hedge. The math did not save them. And suddenly, the fund that had seemed almost invincible was running out of time. By September 1998, LTCM was in serious trouble. If it collapsed suddenly, banks and financial institutions might have been forced to unwind its enormous positions all at once. That could have caused more selling, more losses, more panic, and possibly a chain reaction through the financial system. So the Federal Reserve Bank of New York called major Wall Street firms into a meeting. This is where the story gets controversial. The Fed did not simply hand LTCM taxpayer money. Instead, it helped bring the private banks together to work out a rescue. In September 1998, 14 banks and brokerage firms invested $3.6 billion to prevent LTCM's collapse. The Federal Reserve helped organize the arrangement, but it did not lend its own funds. That detail is important. This was not a normal government bailout. It was a private sector rescue organized under pressure because the alternative looked dangerous. But even without taxpayer money, the message was explosive. If a firm becomes big enough, complex enough, and connected enough, can it force the system to save it? That question did not disappear. It came back 10 years later, much bigger, in 2008. After LTCM, people asked a brutal question. Did Wall Street just learn the wrong lesson? The lesson should have been, do not use extreme leverage. Do not trust models blindly. Do not let private firms become so connected that their failure threatens everyone else. But the other possible lesson was darker. Take huge risks. Make huge profits. And if the losses get big enough, someone may step in to prevent disaster. This is called moral hazard. Moral hazard happens when people take bigger risks because they believe someone else will absorb the damage. LTCM was not rescued because people felt bad for the fund. It was rescued because its collapse could have hurt others. But that creates a dangerous incentive. The more connected you are, the more dangerous your failure becomes. And the more dangerous your failure becomes, the harder it is for the system to let you fail. That is the logic of too big to fail. And LTCM became one of the clearest warnings before the 2008 financial crisis. The central issue was leverage, because leverage can make one firm's problem spread to everyone else. And that warning basically predicted the next decade of financial history. The easy version of this story is, some geniuses made bad bets and got rescued. But the deeper story is more disturbing. LTCM did not fail because its people were stupid. It failed because they were smart in a very specific way. They understood formulas. They understood pricing models. They understood historical patterns. But they underestimated fear. They underestimated panic. They underestimated how fast trust can disappear. And in finance, trust is everything. A model can tell you what should happen under normal conditions. But markets are made of people. And people do not always behave normally. When fear takes over, prices can move further than expected. Correlations can break. Liquidity can vanish. And a trade that looked safe yesterday can become impossible to escape today. That is what destroyed LTCM. Not one bad decision, not one bad trader, but a whole system of confidence built on borrowed money. The LTCM crisis happened in 1998, but it still feels modern. Because the same ingredients keep showing up again and again. Brilliant people, complex financial products, high leverage, weak oversight, big institutions assuming someone else understands the risk. And then, when markets panic, everyone realizes the risk was bigger than it looked. This is why LTCM matters. It was not the biggest financial crisis. It was not the most famous. But it was a warning. A warning that Wall Street could create risks so complicated that even the people involved did not fully understand them. A warning that private bets could become public problems. A warning that smart money can still be dangerously wrong. And maybe the scariest part is this. The rescue worked. The system survived. And because the disaster was avoided, the lesson became easier to ignore. Long-term capital management was supposed to represent the future of finance. A fund where math replaced emotion, where elite models replaced guesswork, where the smartest people in the world could turn tiny market inefficiencies into billions of dollars. But in the end, LTCM proved something very different. It proved that intelligence is not the same as wisdom. It proved that risk does not disappear just because a model says it should. And it proved that sometimes the most dangerous people in finance are not the reckless gamblers. They are the geniuses who think they cannot lose. Because when they finally do lose, everyone else may be forced to pay attention. This was the hedge fund that almost crashed the world. And if you want more stories about money, power, and decisions that nearly changed history, subscribe. Next, I'll cover another modern disaster almost nobody understands. The week Wall Street almost died in 2008. And trust me, that story gets even crazier.